All right, gang. Welcome to our pre-morning show. All right, let's get some audio and video. Let's get an audio and video check-in. I think we should be good to go. All right, welcome, gang. Welcome to our pre-morning show. And we've got a bunch to talk about here. We're going to run about 15 minutes because I do have to be somewhere at 9:15, but wanted to spend this little bit of time with you here all in the morning as we take a look at this Thursday morning trading session. So again, what we're doing here is going through the 6 points, going through our data points, a little bit of edging closer to some macro studies in terms of a rate of change of different data points that are going to matter in Q4. Not quite yet. I don't think that's the narrative yet, but probably after the election. What was the event today? We had initial claims. So we're dealing with the initial claims aftermath. Let's talk about that here. And I'm going to bring up a chart. And let's go ahead and do that. All right, so we're going to bring up a chart. And what we're looking at right now is the ES. Now, by the way, I'm on the Thinkorswim platform here. And we're taking a look at the S&P. Now, at 8:30, we're going to have this massive reaction. I don't want you necessarily playing the number that comes out or even necessarily the momentum. But I do want you to see the way in which the market is discounted, reacted to the release. So we have this initial claims, 8:30 a.m. We'll take a look at the economic calendar here in a moment. And what I want to show you is trading economics. And here you have, as you can see here, just kind of this running tally. Here's our initial claims for October the 8th. And you'll notice the actual was 109.76. The previous was 119. That rate of change matters. So always be aware of the previous number. What's sort of the 4-week moving average of a data point? Then we want to go into that consensus. What did the market actually expect? What's the contrast between 11.4 and 109.7? Clearly, it's a little bit better. We saw the initial reaction for this number was up. That last column there, that TE forecast is a Trading Economics, the website that I have you on right now. That's their forecast. That's what their expectations were. Another way you can look at this is over at Forex Factory. You can scroll on down here and take a look at Thursday. And 8:30, there's our unemployment claims number. All right. So again, we can go through this whole process of understanding what the event actually presented, what kind of volatility it created. I think a lot of traders assume there's a trading event here. Now, there is a trading event occasionally, and I call it a first come, first serve. Now, some of you who have traded with me live are probably familiar with this pattern, but I'm going to teach you a little bit about what sort of the genesis of this pattern was. And it's a pattern that you can use. Well, when I say pattern, it's a volatility reaction pattern, if you want to look at it that way. So let's talk about how that actually works. All right, so a few things before we get into this. What are you going to have to know to play this pattern? What's the historical volatility between 8 and 9 a.m.? That's number one. Which symbol are you going to play in terms of this is an exhaustion trade? Now, what does an exhaustion trade mean? That means we're going to fade the move. Fading the move means if there's bullishness, we're going to sell. And if there's bearishness, we're looking to buy. So that's the way in which we position ourselves on the other end of this velocity. All right. So let me show you what I use to get this data. And let's see here. All right, so the site that I use for this, it's a third-party site. I've been using it for many, many years. And let's see if I can't, why is it not coming up? Because it's a live show, that's why. All right, so let me log in here. Okay. All right. So we're going to take a look at data that I flashed before. Here, let's bring it up. Okay. So this is volatility analysis. This is historical volatility analysis. So I'm going to bring up the S&P, and this is how this first come, first serve came to be. I know that at 8 o'clock, so notice this 8 a.m. bar, 800 hours, right? The lower end of volatility is about 9 points. The upper end of volatility is 18 points. Average is about 14. The upper end of volatility for the S&P is what I would call plus or minus 18. So for an exhaustion move, for a move to really be exhaustive, think about running out of fuel in your tank. Not that any of us want to do that, but think about running out of fuel in your tank. It's going to be closer to that 18, not closer to 9. And 14, you know, you're on a limited tank, but the closer you get to 18, the more you're going to run out of fuel. The market, when it comes to volatility, behaves in much the same way. So keep in mind, plus or minus 18. So as you go into this event, I've got an indicator running that pre-calculates this for me, but it's the same idea. Have we, from the low of the range of the hour, moved up 18 points? Because if we do, on that initial claims number, we're going to end up, if it's plus 18 up in this red, if it's down 18 down in this green. Now, you don't need this indicator to do this. It's simple arithmetic. And I've been teaching this and sharing this since, gosh, I think it's been 7 or 8 years now. So was this an exhaustive move? It wasn't. So the first come, first serve, the reason I call it that is the first exhaustion level that the market goes to. I'll do this for initial claims. You can do this for crude oil inventories, etc. It's got to be a data event. It can't be a speech. It can't be an elongated event. It's got to be where the market just gets a data event, gets a piece of data, has to react to it instantly. So I don't have an exhaustive move here. So this 830 resulted in nothing. Had I gone up to that red, I would have shorted the market likely. And had I gone down to the green, I would have likely bought that. So just because the S&P didn't do it doesn't mean the NASDAQ or the Dow may not have, but you can check that out here. And none of these markets actually hit that level. So no first come, first serve. However, you might say, but Rag, we did head higher, and we headed higher into the lower end of this range. That's what this dotted line is. I'm ideally looking for that red zone. But if you're going to fade anything, it's going to be a fade short because the market responded higher, moved into a historical volatility zone of resistance, and there may be a short there. Okay. The more exhaustive, again, think plus or minus 18, the better, or even greater than 18, the better. So keep that in mind. I know this might be a little advanced, but this is what we're getting today. This is the pre-market mood. This is the pre-market mood and move that we're getting. Okay, a couple other things. Are we getting a gap today? Do we have gap psychology in play? Let me open up the TradeStation charts, and I'm going to include, going back to yesterday, looking at 4 p.m. Eastern, the cash close, and the high and low that was established between 9:30 and 4. So when you take a look at this, I know there's a lot of data scrunched in here, but don't worry about it. We're not trying to do any kind of candle recognition or pattern recognition. This is just a matter of what was the highest high of the day and where was the close, and are we currently, even after this initial claims, are we currently with 20 minutes to the market, to the bell, are we above it? Yes, we're above the close and we're above the high. This is ideal gap psychology, and I will anticipate a potential fade. Now, yesterday we did have some gap psychology in play, but you'll notice the market didn't fade. And one of the things you'll notice is that the market did not open above both the 4 p.m. close and the regular trading hour, the RTH high. When we open above both, there's usually a better likelihood of a fade. So this is going to be a potential fade. All right. So a couple of questions here, but doesn't the fact that we had the initial claims data release make the historical vol for 8 to 9 a.m. invalid? Well, if you're looking at average true range, that would be true, because average true range is just not going to have enough data. Maybe it's looking at 14 periods, 21 periods, whatever the typical popular or your preferred average true range setting may be. I mean, think about how little data you're actually using. But this is price movement range. This particular, and that's a great question, by the way, Abhishek. So this particular graph that's in front of you right now is factoring in 6 months. So think of it this way. 6 months means weekly initial claims. We've seen 24 of those averaged into that graph. Does that make sense? So 24 initial claims were averaged into that particular graph to give us these ranges from 9 to 10 o'clock. So the answer is no, but I wanted you to know why. It's because we have already seen 6 months worth of initial claims affect that 9 to 10 a.m. historical price movement range, hourly historical price movement range bar. So this is where having a more historical look can factor in non-farm payroll, can factor in FOMC events. Look how the 2 o'clock is a slightly higher on average bar than 1 p.m. Eastern, it's all Eastern, because this is averaging in months, 6 months worth of FOMC minutes, FOMC statements. So it is already factored in to a certain degree. So no, I will not consider it invalidated. It's still highly accurate, but terrific question. All right, so we're going to open up with gap psychology, and let's open this up here. So we are not only above yesterday's regular trading hour high, we're also above the 4 p.m. close. And that's probably between initial claims and this first come, first serve, that you've got a little bit more information and awareness of. And then initial claims leads to a certain amount of, I'd say, bullishness we're going to see on the open. It keeps our gap psychology, we've defined the gap, intact, and very likely I'll be looking for a fade on the bell. Now, the fade is going to be a short. It's going to be a short sell. Doesn't mean I just short on the bell. I'll be looking for a very specific pattern. However, I do want to remind everybody that fade is a very brief and about a 50% retracement of the distance between the 4 p.m. close and the 9:30 open. That's really my first target, about 38.2 to 50%, maybe 61.8% of the points, the space between the 4 p.m. close and the 9:30 a.m. Eastern open. So I'll be looking for a gap pattern to form. And then after that, if there is a fade, then I'll be going back to my directional bias, which is bullish, which means I, for the most part, will not consider shorts beyond the gap fade and go right to looking for the lower end of the range that I can buy into throughout the morning. All right. As far as the VIX goes, Nicholas, I don't believe the VIX has necessarily been incorrect, but in terms of why the VIX went up suddenly, it could be initial claims. I'd have to take a look at the chart. It could be in sync with initial claims. It could be in sync with a lot of different moves. Typically, the VIX and the indices have an inverse relationship. So as the equity markets move up, you're going to see the VIX head lower. You'll also very likely see things like the yen head lower. You should ideally see things like the Australian dollar head higher. So there's a lot of things that you can look at. I consider that a market barometer. VIX, bonds, Australian dollar, Japanese yen, they will give you some insight into sort of the mood of the market. Maybe that's something we'll talk about in an upcoming episode. All right, so that's what we've got going on this morning, gap psychology, bullishness coming out of the 8:30 a.m. initial claims. Unfortunately, we could not fade that, which I would have been fine with a quick fade. Notice the shorts that I'm taking are very quick in nature. They're very brief in nature. I don't want to be committed overall to a short in the markets. I'm actually looking for long positions, but I don't mind these brief, more aggressive shorts early on in the session. Those shorts actually are going to feed potentially our longs, okay? No, we do not have the price movement range for TradingView. It's only for right now Thinkorswim. This price movement range tool of mine. Yes, it's the data comes from AutoChartist. The calculation was mine, and the right now I just it has to be updated every week, and I only update it for TOS right now. Okay. All right, gang. I do have something to do right now, but tomorrow we'll go back to our regular 20-minute. Thank you so much for tuning in. Thank you so much. You know, if you subscribe, I think it'll let you know when I go live. So go ahead and subscribe to the channel. You'll know when I go live with these pre-markets. Thank you all for the thumbs up. I really appreciate it. If you have any questions or comments, leave them below. I do read them. I do respond. So if you're catching this on replay or even now, if you have any questions or comments, leave them below. I'll check them out. I'll answer, and I'll see you tomorrow. All right? Be good to each other, gang. I'll see you in the next pre-market.